Hello, my name is Mark Tracy. In this video, I'm going to discuss some important things that you can do to invest for both safety and for maximum return. One of the first questions often asked by those who choose to invest in the stock market is, how many stocks should I own? Here's what investing guru Peter Lynch has to say. It isn't safe to own just one stock because in spite of your best efforts, the ones you choose might be the victim of unforeseen circumstances. In small portfolios, I'd be comfortable owning between 3 and 10 stocks. Legendary investor Warren Buffett recommends owning 5 to 10 sensibly priced companies. While some might wonder whether it's safe to own just 5 to 10 companies, writer Robert Hagstrom explains Warren Buffett's reasoning. Buffett eliminates financial risk by excluding from purchase those companies with high debt levels, and Buffett further reduces risk by focusing on companies with consistent and predictable earnings. Buffett explains, if you are able to understand business economics and define 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification, i.e. owning a lot of stocks, makes no sense for you. It is apt simply to hurt your results and increase your risk. Buffett continues, I cannot understand why an investor would put money into a business that is his 20th favorite rather than simply adding that money to his top choices. Another advantage to owning just a few stocks is that it makes it easier for you to focus on just a few selections instead of having to try to keep up with dozens of stocks. Now let's examine some of the ways that you can screen your stock picks for safety and maximum return. Let's start with debt. As a basic rule, you should avoid companies that have too much debt. Too much debt and having to service that debt can be a weight on a company's earnings. It can even put a company into bankruptcy. To gauge a company's debt level, you should examine its debt-to-equity ratio. As the website Investopedia tells us, the debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. It reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. Generally speaking, a debt-to-equity ratio below 1.0 would be seen as relatively safe, whereas ratios of 2.0 or higher would be considered risky. A second way that you can increase the safety of your stock picks is to choose companies that have a history of consistent earnings growth. A record of steady earnings growth bodes well for the future earnings and for the continued success of a company. Shown first is the earnings per share or EPS record of Shake Shack, a company with spotty, inconsistent earnings, followed by Apple, a company that's maintained fairly consistent earnings growth over time. Companies like Apple are what we're looking for. So how do we know that a company that has produced consistent earnings growth will continue to grow and prosper? We can't know this for sure. However, as long as nothing major has changed with the company, past performance can be a strong indicator of future performance. In short, it's much safer to go with a company with a strong earnings history than with a company that has a spotty record. It's all about putting the odds in your favor. A third way to increase the safety and the maximum return of your stock picks is to search out companies that have some sort of niche or competitive advantage, what Warren Buffett calls a moat. Warren Buffett says, "A truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns." Buffett adds, "What we're trying to find is a business that, for one reason or another, has a moat around it. It can be because it's the low-cost producer. It can be because it has natural surface capabilities. It can be because of its position in the consumer's mind. It can be because of a technological advantage, or any kind of reason at all." Companies with strong brand loyalties like Nike, Coca-Cola, and Apple often have strong moats. There is even an objective metric we can use for gauging whether a company has a moat. It has to do with return on equity. Morningstar's Pat Dorsey tells us, "Only about 1/10 of the non-financial firms in Morningstar's database were able to post a return on equity above 10%. As a rule of thumb, firms that are able to consistently post returns on equity above 15% are generating solid returns on shareholders' money, which means they're likely to have economic moats. And if you can find a company with the potential for consistent returns on equity over 20%, there's a good chance you're really onto something." A fourth way to increase the safety of your stock picks is to verify that a company's net earnings are in sync with its cash flow from operations. Morningstar's Pat Dorsey says, "For a host of reasons, net income could be made to say just about whatever a company's management wants them to, but cash flow is much harder to diddle with. Over time, increases in a company's cash flow from operations should roughly track increases in net income. If you see cash from operations decline, even as net income keeps marching upward, or if cash flows from operations increases much more slowly than net income, watch out." Now let's compare Apple's net income to its cash flow from operations, otherwise known as cash flow from operating activities. We see that Apple's net income and cash flow from operations track well with each other over time, which is what we are looking for. In summary, in choosing stocks, we are looking for acceptable levels of debt, consistency in earnings, evidence of a moat, and consistency between a company's net income and its cash flow from operations. After applying these 4 tests to a basket of stocks, you'll find that you have eliminated the majority of them from consideration. The process of elimination will continue further when you take the next step, paring down the number of companies based on their stock price. We'll discuss that in our next video. How much should you pay?